So what if I told you there's a single, totally under-the-radar company out there handling a staggering $30 billion in annual payment volume across the globe? Seriously, $30 billion. It's not a typo. It's just a massive scale that we rarely see hiding in plain sight.
Welcome to This Explainer. Today, we're diving deep into a complete, data-driven stock analysis of this exact company, Flywire, ticker symbol FLYW. We're going to step right into the shoes of an expert investment analyst, putting this stock through the ringer using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some rigorous discounted cash flow modeling.
All right, here's our game plan. First, decoding Flywire's model. Then, revenue versus margin reality. Third, the guru lenses. Fourth, DCF and alternate valuations. Fifth, key strengths and threats. And finally, our synthesis.
Let's kick things off with Section 1, Decoding Flywire's Model.
Okay, here's the snapshot. Flywire is a global payments enablement and software company. Right now, it's trading right around $14.69 a share, which gives it a market cap of roughly $1.6 billion. Essentially, you can think of them as the hidden financial infrastructure layer that actually makes complex cross-border payments happen.
But here's what's really fascinating about how they actually hit that $30 billion in volume. They don't just process credit cards like your local coffee shop. No, they literally embed their proprietary software straight into the accounts receivable workflows of massive institutions across 240 countries. We're talking core verticals like education, travel, healthcare, and B2B. For instance, they integrate directly into huge enterprise systems like Workday, so they become this deeply sticky, almost indispensable part of how major universities and hospitals collect their cash.
Moving on to Section 2, revenue versus margin reality.
Guys, Flywire has an absolute rocket ship of a multi-year revenue growth engine. Look at this. Back in 2019, they were doing about $95 million in revenue. Fast forward to 2025, and that number skyrockets to over $623 million. And they just capped that off with a huge Q1 2026 earnings beat, where revenue jumped an incredible 41% year over year. But wait, we really have to pause and emphasize this stark contrast. While their proprietary network commands really strong gross margins of 61.4%, their actual net profit margin is, well, it's a razor-thin 2.2%. So what does this mean for us? It means they're generating massive volume and top-line revenue, but right now they are heavily reinvesting it, which leaves almost nothing at the actual bottom line.
Okay, let's jump into Section 3, the guru lenses.
First up, let's look through the Warren Buffett lens. Now, Buffett always looks for a strong economic moat, and Flywire definitely has that thanks to its embedded software and the huge switching costs for its clients. He also likes honest, shareholder-aligned management, which we see with Flywire's recent $50 million accelerated share buyback. Oh, and he loves low debt. Flywire hits the mark there with a pristine debt-to-equity ratio of 0.05. Plus, their approximate owner earnings, using free cash flow, sits at a solid $117.5 million. But here's the absolute deal-breaker for the Oracle of Omaha. Buffett demands a consistently high return on equity, and Flywire's ROE is a meager 1.6%. Honestly, because of that lack of consistent, high-margin profitability, Buffett would almost certainly pass on this stock at today's price.
Now, let's flip the script and look through the Peter Lynch lens. Lynch would instantly categorize Flywire as a classic fast grower. He absolutely loves companies growing at 20 to 30% a year. And remember, Flywire just posted 41% growth. Lynch is also big on strong balance sheets, and Flywire is sitting on over $311 million in cash. But the kicker here is the PEG ratio. That's price to earnings relative to growth. With a forward PE around 11 and growth soaring past 40%, their forward PEG ratio is well under 1. That is highly attractive. Throw in that insider buying via the corporate buyback, and Lynch would practically be shouting a strong buy opinion here.
Finally, let's apply the Benjamin Graham lens. Graham is the ultimate, strictly by-the-numbers defensive value investor. If we run his checklist, adequate size? Yep, it's a $1.6 billion company, pass. Earnings stability? Fail. They've historically run at a loss. Dividend record? Fail again. They don't pay one. Now, let's crunch his famous intrinsic value formula. That's the square root of 22.5 times an annualized earnings per share of roughly 40 cents times a book value per share of $6.56. That outputs a super strict intrinsic value of exactly $7.68. At today's price of $14.69, there is literally zero margin of safety. Graham wouldn't even look at this stock unless it tanked below $7.
Moving right along to Section 4, DCF and alternate valuations.
Let's build a base case discounted cash flow, or DCF model. We'll use their trailing free cash flow of $117.5 million as our jumping off point. If we assume an industry standard 10% weighted average cost of capital, or WACC, and a perpetual terminal growth rate of 3%, our 5-year DCF model projects a highly optimistic fair value of $78.18 per share.
But here's the thing, and this really perfectly illustrates the wild nature of growth stocks. We have to run a sensitivity table. If we assume a slightly lower WACC of 8% and 4% growth, the fair value just absolutely skyrockets. On the flip side, if the macro environment tightens up and we bump that discount rate to 12% with only 2% terminal growth, the intrinsic value plummets drastically. It just shows you how incredibly sensitive growth valuations are to capital costs.
So to balance out that DCF, we've got to apply some alternative models. If we use the super conservative earnings power value method, which assumes zero future growth and just looks at current distributable cash, the value drops down to $9.60 per share. On the other hand, if we use a comparable forward PE multiple approach against other high-growth fintechs, we get a fair value of $43.89. So you can see, we're working with a massively wide fair value range here.
Now for Section 5, Key Strengths and Threats.
Remember those razor-thin profit margins we talked about earlier? Well, management is actively executing a clear strategy to combat them. First up is artificial intelligence integration. They've actually deployed AI to slash customer support handling times by 30% and speed up payment processing by 20%. Second, they're expanding their total addressable market by aggressively pushing into the hospitality and B2B sectors. And third, they're putting that pile of cash to work through strategic international M&A to literally buy market share.
This whole strategic push is anchored perfectly by a recent quote from CEO Mike Massaro. He said that the results reflect a business that is, quote, increasingly resilient and increasingly profitable. You see, the management team is acutely aware that to survive and thrive in the public markets, they absolutely have to scale their profitability right alongside those massive revenue jumps.
But putting our analyst hats back on, we have to look impartially at the external threats. The reality is, this business is highly sensitive to macroeconomic slowdowns. I mean, if travel or education spending drops, Flywire's volume drops right with it. More specifically, they are currently facing some acute regulatory headwinds from shifting international visa rules in Canada and Australia. That directly impacts the number of foreign students paying tuition through their core education vertical, which is a big deal.
All right, let's bring it all home with Section 6, Final Synthesis. Blending all these insights together paints a really fascinating picture. Look, Flywire is a clear pass for strict defensive value investors like Benjamin Graham, who wouldn't touch it unless the price dropped below $7.68. Buffett is also a pass right now, at least until that return on equity sees a dramatic improvement. However, our DCF and forward PE models strongly suggest the stock is actually undervalued right now. That makes it a huge buy for growth investors who align with Peter Lynch's philosophy. So our final synthesis? It's a speculative hold or buy at current prices, totally depending on your personal appetite for growth stock risk.
Ultimately, the entire investment thesis really just boils down to one major question. As AI adoption and global expansion accelerate, can Flywire actually transform that astonishing $30 billion in raw payment volume into real, sustainable, bottom-line profit? If they can, today's price is an absolute steal. But if they can't, it might just be a value trap. Thanks so much for joining me on this explainer, and I highly encourage you to go dig into these numbers for yourself.